Hello. Today I'm joined by Edmund Harriss, Fund Manager of the Guinness Asian Equity Income Fund. The fund invests in high quality, dividend paying companies based in the Asia Pacific region. China is the biggest country weighting in the fund. Is this where the best income opportunities are in the Asia Pacific region? And in addition to that, how much attention do you pay, if any, to the wider macro backdrop?
I would say we hold China because there is a very large opportunity set in China. We have a choice now, as China has developed, across a wide range of sectors. It's not just about making a macro call and where sort of investment growth is coming. We have access to the financial sector in China, but we also have access to a range of consumer discretionary names, to consumer staples names, industrials names. It reflects the sort of the breadth and the economic hinterland, I suppose you could call it, in China. And so we have a lot of opportunities at our disposal. I think I wouldn't characterize it in terms of that's where the best income opportunities are, but certainly it is where there is a good set of companies that are able to grow and develop and produce cash flows. And I guess from that perspective, there is a good source of income to be had from there. When we think about investing in China, and indeed if we're investing anywhere in the region, we try not to do it on a macro basis. What we're looking at in the first instance is a good company, so a good business model. What are they producing? How efficiently are they producing it? How much are they making? How much are they selling it for? What is their cost structure? Are they able to pass on higher input costs to their consumer? How do they, how are their margins looking, and how defensible are they? And then we place that company in the context of its industry and what the competitive environment is like. Place that industry in the context of the country in which it operates, and then consider additional macro factors on top of that. But you're building up from the bottom. Find the business first, then look to see if you can understand the threats and the pressures on the business itself, and then consider its valuation in terms of the overall macro environment.
Could you run through three stock examples of companies that have a proven track record of sustainably growing their dividends and look well placed in the future to continue raising their dividends?
I'll deliberately choose one or two that are not necessarily that well known, but we'll start with JB Hi-Fi in Australia. It is an electricals retailer selling computer equipment, office equipment, DVDs, but has also broadened out and diversified its product range to include household durables as well. Now, it has grown its dividend steadily since 2012. It operates in a fiercely competitive environment. As the Australian market always is, there's only room for a handful of players. And JB Hi-Fi have a very experienced management team that have had to cope with intense competition, the arrival of Amazon, now the arrival of COVID. And throughout these sort of periods and changes in the industry, they have managed to keep steady growth throughout that period. Margins are quite tight, but nevertheless, through careful management, and it is down to the management skill, they have been able to defend and slightly expand those margins. And so you've seen incremental growth in the dividend. So it's been a really nice sort of steady story. Another example, moving into a completely different area, is China Medical Systems. As its name implies, it operates in China. And historically, it has been a sort of contract sales business, representing foreign drug makers in China to sell their drugs around the sort of doctors and hospitals particularly. And their focus has been very much on generic types of products. That business has done very, very well for many, many years. It has grown its dividend year after year since 2010. But the story behind this business is one of high returns on capital, which have been sustained. The market got particularly worried last year and was looking or was pricing its shares as if those returns were going to halve. They did not. And the latest results showed a 29% increase in revenues and a 60% increase in the dividend. So the story continues to play out. A third example, moving over to Taiwan, takes us into the IT space. In this case, Lagan Precision is a manufacturer of camera lenses, so, particularly for use in smartphones. So as we've moved into higher and higher definition cameras, where smartphones now have replaced the digital still camera almost in entirety, and you now have triple cameras and quadruple cameras, their camera lenses and modules are at the top end of the market and have remained so. And this company has maintained its position at the top end. It hasn't been tempted to go down into lower end and compete and scrummage with the rest of the market. They maintain their position at the top end. So it's a high returns business. They've grown their dividend pretty much in a straight line since 2007. High return business, a lot of cash on the balance sheet.
In terms of portfolio activity, has the past year been a busier period than usual due to the pandemic? And could you run through some of your latest buys and sells in the fund?
What we were looking to do and have been looking to do for a while, which was in fact interrupted by COVID, was to take out some of the deeper value plays from the portfolio and replace those with businesses where there is greater growth. A core element of this portfolio is companies that grow their profits and deliver a growing dividend. Now, you can incorporate into such a portfolio one or two names where the profit growth isn't really coming through, but they are able to sustain a high dividend. But the high dividend itself isn't growing. That's fine over a short period, but over time, what you want to see is a growing dividend so that your investors are receiving a growing income stream. So you're effectively seeking to preserve that capital stream in real terms. So dividend growth is a very important part of the strategy. So we had one or two deeper value names. An example will be Yangzijiang Shipbuilding in Singapore, a builder of container vessels, which has been very successful in its own line of work, but the shipping cycle is not working in its favour at the moment, and it was sustaining its dividend. But I felt you're not going to get any capital support from that, and the value of that dividend is going to gradually erode. So let's find one where we are seeing profit growth and dividend growth. We moved into names like Shenzhou International, which is a textiles manufacturer, clients like Adidas, Puma, Nike, Uniqlo, Ralph Lauren, sort of a range of both sport and casual clothing customers. Shenzhou operates some manufacturing in China, but a lot more in Southeast Asia and particularly in Vietnam. It's been a very, very successful business for a lot of years. It has grown its dividends steadily since 2012. The stock has traded expensively for quite a while, but COVID, when it arrived on the scene, particularly around sort of February or March of last year, caused that stock to slump, and so we moved into that stock at that particular juncture. Another area, one that we've moved into is Nian Made Enterprise in Taiwan. Funny sort of business. I mean, it makes shutters and blinds. It's based in Taiwan, but it sells its products in Japan, in the United States, in the UK, and also has a sales office in Belgium as well. They are plays not only on new home building, but also on home upgrades. A lot of their stuff is, say, sold through Home Depot in the United States, or you'll find stuff that is sold through B&Q. But the company is moving more and more into producing bespoke products. So, as in line with those technology companies that are seeing a rising price of copper, which is pressuring their margins. So Neon Made Enterprises is seeing pressure on prices for PVC, which is a big component of their inputs for shutters and blinds. So by moving into the bespoke type of business, then they are able to defend their pricing. And the final example is a China A-share company, Swafea Home Collection, which is a maker of home furnishings, doors, kitchen cupboards, sofas. They have done very well in the higher tier cities and moving down into the sort of the lower tier cities. They have a very, very large offline as well as online distribution network. They have a relationship with a French company called Schmidt, which is a maker of higher end cabinets in France, and you can get Schmidt products here in the UK. But Swafea have done a joint venture there, so that is also rolling out in China. But a fiercely competitive space. But this is a company, again, that has generated returns on capital of over 12% for over 10 years now. And if you can do that in the face of that type of competition, that's more than just luck. They clearly have a market, a brand, and a management team that understands the way the market is moving.
Edmund, thank you very much for your time today.
Great, thank you.